Okay, so, you're out there trying to keep up with everything happening in the markets, and honestly, it's a lot, right? There's just so much information coming at you from every direction. It's like, how do you even know where to focus?
Yeah.
That's where we come in. This deep dive. Think of it as your cheat sheet to help you really grasp what matters. Today, we're diving into structured products.
Yeah. We're going to be looking at how these things actually work, especially when you've got all these different market conditions going on. And, a lot of people talk about capital protection. We really want to break down how those barriers work to hopefully help you understand how much protection you actually have. And we'll be looking at a few examples of some live notes, some that are out there right now.
Perfect. So for anyone who's like, wait, what even is a structured product? The Investor's Guide, that's one of the sources we've got for this deep dive. They put it pretty simply. They say it's basically a financial investment where you know the potential returns and the risks from the get-go.
Yeah.
And it all happens within a fixed time period. So you're essentially signing up for a financial contract with terms that are already set in stone.
Yeah, exactly. And you got to remember, these are classified as alternative investments, right? And that often means there's a possibility of getting higher returns compared to traditional stuff, like just buying stocks. And what's really interesting is they often come with a built-in level of protection. You don't usually get that with regular investments. Now, these products, they're created by institutions, or, financial institutions, and how they perform is linked to an underlying asset. Could be a whole stock market index or just a single company stock, even commodities, lots of options.
Okay, so big picture here. What are we really trying to figure out today? It's all about how these structured products try to do two things: make you money and at the same time protect your initial investment. And we want to see how they stack up against, the more traditional route of just buying and holding stocks.
All right, let's start with the basics. How do you actually make money with structured products? The Investor's Guide lays out three main types: conditional income, fixed income, and growth products. We can tackle those one by one, right?
Yeah. Let's start with conditional income. These seem to offer the potential for regular payments, like maybe every quarter or twice a year or annually.
Yeah.
But there's got to be a catch, right?
Yeah.
Because they're called conditional for a reason. It depends on how those underlying assets perform.
Exactly. So let's say you've got a product that says, all right, we'll pay out income if the price of the underlying asset stays at or above 100% of its value on the strike date.
And just to clarify for everyone, the strike date is basically day one, right? It's the initial date they use to figure out the starting value of whatever that asset is.
Yeah.
And then from there, they compare all future performance to that starting point.
Precisely. So the Investor's Guide has this example where they show income being paid out in years 1, 2, 3, and then 6. This was out of a 6-year term. Why those years? Because the underlying asset met that condition. It was at or above that 100% level. But get this. In years 4 and 5, the price dipped below that level, so guess what? No income paid out.
So it's like you've got to clear that hurdle to get the payout. Makes sense. Now, I also saw something called a memory feature, and that sounds like it could be pretty handy.
Oh yeah, that memory feature is a nice little bonus. Some of these products, especially those conditional income ones, they'll have it built in. What it does is it basically remembers those times when it should have paid out but didn't because the price was too low. So let's say the asset drops below that income barrier for a bit, then it bounces back up and clears the hurdle again. Well, with the memory feature, you might get not only the current income payment, but also the ones that were missed earlier when the condition wasn't met. They've got a whole chart in the Investor's Guide that really shows how much of a difference this can make for you, the investor. But, two sides to every coin, right? For the institution issuing these products, the memory feature can mean they have to cough up a bigger payout if the underlying asset really takes off later on.
Makes sense. It remembers those missed opportunities and catches you up when things are good again. Pretty cool, huh? So we've covered conditional income. What about fixed income? That sounds, I don't know, maybe simpler?
Yeah, fixed income products are designed to be more predictable. They pay out a set amount at regular intervals, no matter what the underlying asset is doing. So the Investor's Guide uses an example of a product offering a guaranteed 10% income annually. Sounds great, right? But while the income is fixed, your initial investment, what happens to that at the end of the term? Well, that still depends on how well the underlying asset performed.
Got it. So steady income, which is nice, but you still got to keep an eye on that underlying asset to see where you'll land when the product matures. And then there's growth products. Those seem to be playing a whole different game.
Exactly. Growth products are all about maximizing that potential return at the end of the term. They might have some capital protection built in, but they usually don't pay any income along the way. The investor's guide gives this example where a growth product gave a 60% return because the underlying asset ended up above 100% of its starting value at maturity. And they even compared it to just investing directly in that same asset, which only grew by 40%. So you can see how in certain conditions, the structured product could really boost your returns.
So you're foregoing that regular income for the chance of hitting a home run at the end. Makes sense. Now, there's also something mentioned about an auto call feature. What's the deal with that?
Yeah, the auto call. That's a pretty neat feature. Basically, it allows the product to mature earlier than planned, but only if the underlying asset hits a certain level, they call it the auto call barrier, on a specific observation date. And both income and growth products can have this. The investor's guide has this example where a product auto-called, meaning it matured early, on the third annual observation date. Why? Because the underlying asset hit that auto-call barrier. And what happens then? Investors get their initial investment back, plus whatever return was agreed upon up to that point. So, if the market takes off early, this could be your ticket to a quicker return.
So like an early exit strategy with a potential bonus if things go well. I like it. Okay, we've talked about how you can make money with these things, but let's get to the heart of it. How about protecting your investment? The investor's guide makes it clear that capital protection is a big deal, and they talk about these things called protection barriers.
Right, so these protection barriers, think of them as like a safety net. They're designed to limit how much you can potentially lose. They basically create a buffer so the underlying asset's price can drop a certain amount before your initial investment is actually on the line.
The guide goes into different types of barriers, but they really focus on the final level barrier, sometimes called the European barrier. What's the most important thing to know about this one?
The big thing with the final level barrier is that it only matters on the very last day of the product, on the final valuation date. So even if the price dips below the barrier at some point during the term, you're still good as long as it's back above that barrier on that final day.
Okay, so it all comes down to that last moment. They give an example of a 60% final level barrier. Can you walk us through what could happen at maturity with the barrier set like that?
Sure. Let's say on that final day, the underlying asset's price is at or above its starting value. You get all your initial capital back. Now, what if it's below the starting value, but still above that 60% barrier? Still good, you get your initial capital back. The only way you lose money is if the asset ends up below that 60% barrier on that final date. And even then, the loss is usually tied directly to how much the worst performing asset dropped from its starting point. So if it ends at, say, 55% of its initial value, you'd get 55% of your investment back.
Now, that's a really important difference compared to just owning stocks. With stocks, if the price goes down, boom, you're instantly down money, right? How does this capital protection with structured notes compare to that kind of risk?
It's a whole different way of managing risk, yeah. With stocks, a drop in price means an immediate loss for you. But with a structured note, and especially one with that final level barrier, you only lose capital if the price is below that barrier on that very last day of the product's term.
So even if the market takes a tumble during the note's life, as long as things recover and the price is above the barrier by the end, your initial investment is safe.
Exactly. And here's where it gets interesting, especially when we consider our focus for today. Even if the market is generally going down, you can still make money with these notes if those preset conditions for income payments or that auto call feature are triggered before that final valuation date. You might be getting those income checks, or the note might auto call and you lock in some profit even if the underlying asset ends up lower than where it started, but still above that protection barrier at maturity. That's the beauty of these products. They can work in all sorts of market scenarios.
That's a really key point. So even in a down market, you could still come out ahead. Now, to get a better feel for all of this, let's look at some real examples. We've got some details on a few structured notes that were out there as of March 3rd, 2025. Let's dive into those and see how all these features work in practice.
Great idea. Let's start with this one. The BBVA 2Y8065 Blue Chip Tech Annual Memory Income Auto Call. It's got the ISS 29589848887 and an ISINSIN, just so everyone knows. It's basically a unique ID for a security. This note is linked to a basket of tech stocks, big names, NVIDIA, Palantir, and Tesla. And listen to this, it offers a potential annual coupon of 50%.
Whoa, 50% annually, that's huge.
It is, but it comes with conditions, of course. To get that 50%, all three of those stocks need to be at or above 80% of their initial price on the annual observation date.
Right, got to clear that hurdle. And this one has that memory feature too, right? So even if they miss a year, there's a chance to get that income later. What about the auto call and the protection on this one?
So it's got an annual auto call set at 100%. That means if, after 1 year, all three stocks are at or above their starting price, the note matures early and you get your initial investment back plus that 50% coupon. Now, if it doesn't auto call in the first year, it runs for a total of 2 years and has a 65% European capital risk barrier. What that means is your initial capital is protected unless any of those three stocks close below 65% of their initial price on that final valuation date. If that happens, your return is basically linked to how the worst performing stock in that basket did.
So high potential income, possible early exit with a profit if those tech stocks do well, and some protection against big losses at the end of the 2 years. Let's switch gears and look at a different type. How about the Marex 4Y EU Index 100% Capital Guaranteed Issuer Callable Participation Note? That's a mouthful. ICE and XS2851880 on auto. This one sounds like it takes a totally different approach.
Yeah, this one's all about protecting your money. It offers a full 100% capital guarantee at maturity. So, no matter what happens with the Eurostoxx 50 index, which is what this note is linked to, you're guaranteed to get your initial investment back after 4 years. It also has this thing called a quarterly issuer call option. That basically means Marex, the company that issued this note, they have the right to redeem it early if they want to.
So they can kind of pull the plug early if it suits them. Interesting.
Right. And it doesn't pay regular income, but it does give you full participation in any gains the Eurostoxx 50 makes over those 4 years. So you're essentially betting on the European stock market doing well, but with the peace of mind that your initial investment is safe no matter what.
Okay, so low risk, potential for reward if Europe does well.
Got it.
Let's look at one more. The Santander 4Y Global Bank's quarterly income auto call with memory. The ASN is XS29923014778. This one sounds like it's bringing a few different things together.
Yeah, this one is linked to a basket of bank stocks, JP Morgan Chase, BBVA, and Citigroup. It offers the potential for quarterly income payments, and it has that memory feature we talked about. The potential annual rate is 16.5%, but to get that income, all three of those bank stocks have to be at or above 90% of their initial price on the quarterly observation dates.
Okay, so potentially regular income, but those banks got to perform decently well.
Exactly. And it has a quarterly auto call feature, too. If all three banks are at or above their initial price on any quarterly observation date after the first 6 months, the note auto calls. You get your investment back, plus any income you've earned up to that point. And of course, it also has a 65% European capital protection barrier at the end of the 4 years.
So once again, we're seeing that combo. Potential for income, a chance for early redemption, and some level of capital protection at the end. It's really fascinating to see how these different notes are structured, with all these variations and potential returns, the conditions that have to be met, and the different levels of protection. It's also super important to remember that those close dates you might see, they only apply to these specific notes we're talking about today. These structured products, they're constantly changing, new ones are being introduced all the time, so these exact notes might not be around forever.
That's a really important point. This is not a static market. It's constantly evolving. Financial institutions are always coming up with new products and new offerings. So while these examples give you a good idea of how things work, the exact products that are available will change over time.
Okay, good reminder. So we've covered how structured products work, how they can potentially generate returns, and the whole concept of capital protection. But like with any investment, it's super important to be aware of the risks. What are some of the things that could go wrong with these products? I know the Investor's Guide mentions a few, and the product fact sheets have some details too.
Yeah, definitely. Risk is always a part of the equation. First up, there's market risk. We've been talking about those underlying assets a lot. Well, their prices can go up and down, and if they don't perform as you expect, you might not get those income payments or the big return you were hoping for at the end. Then there's something called issuer risk, sometimes called bank risk. Basically, this is the risk that the institution that issued the product might default. If that happens, you could lose some or all of your investment. But the Investor's Guide points out that deVere does a lot of research on credit ratings and usually works with institutions that are considered investment grade. For instance, BBVA, the issuer of one of the notes we talked about, has a credit rating of A from Standard & Poor's, and Marex Group plc, which issued another one of the notes, they have a BBB rating from both S&P and Fitch.
So there's always that risk, but there are ways to mitigate it. What other risks should people be aware of?
Liquidity risk is another one. Generally, you can sell structured products before they mature, but you might not get as much money back as you put in. That's because they're really meant to be held until maturity. And for those products with income payments, there's the risk that you won't receive any income if those preset conditions aren't met. And then, of course, there's the risk that you could lose some of your initial investment if the capital protection barrier is breached on that final valuation date. So it's not like a foolproof, guaranteed safe investment.
Yeah, you got to go in with your eyes open. These products offer some protection, but it's not a guarantee against all losses. And the returns really depend on certain market conditions happening.
Absolutely. You really need to understand the details of each individual product, figure out how likely those conditions are to be met based on what you think the market will do, and then decide if it's a risk you're comfortable taking.
All right, so let's recap. Structured products, what have we learned? They offer a set of possible outcomes that are defined in advance. They can give you regular income or the potential for big growth. And many of them have these capital protection features, like those barriers we talked about. But here's the key difference between these and just owning stocks. With stocks, if the price goes down, you lose money right away. With a structured note, especially those with the final level barrier, you only lose capital if the price is below that barrier at the very end of the term. And even if the market as a whole is going down, these notes can still make you money if those conditions for income or the auto call happen to be met before that final maturity date.
Yeah, that sums it up pretty well.
So if you're listening to this, think about how these features, the potential returns, the income, and the capital protection fit with what you're trying to achieve with your investments. And think about your own risk tolerance too.
Yeah, this deep dive has given you a good overview, but it's just a starting point. Do your research, look into the details of any structured product you might be considering, understand those underlying assets, and talk to a financial advisor. They can help you figure out if this type of investment is right for you.
And on that note, here's a final thought for you to chew on. We've seen how structured products offer a balance between defined risk and the potential for specific types of returns. So how could you use these products as part of a bigger, more diversified investment plan, especially when you're dealing with all the uncertainty that comes with the market? It's definitely something to think about as you navigate your own investment journey. Thanks for joining us on this deep dive.